Welcome in, everybody. Ready for another deep dive.
Absolutely. Always ready to get into the weeds.
Well, today's deep dive is into one of the more fascinating business case studies I've encountered.
Mm.
It involves, of course, beautiful cars, the kind of cars that get your heart racing.
Who doesn't love a Porsche?
But it's not just about the cars themselves. It's about how Porsche, the company, known for engineering excellence, how they maneuvered into the world of high-stakes finance
High stakes indeed.
back in the mid-2000s.
Like we're talking about.
We'll be relying on a business school case study that really digs deep into their actions.
Yeah, great source material, lots to unpack.
Because it raises some really intriguing questions about the nature of risk management itself.
For sure, especially when you consider.
Now, to set the stage, we need to rewind back to the early 1990s.
Yeah.
Porsche almost went bankrupt.
Huh?
Global recession, weak dollar, they were hit hard.
Really hard. They were over-leveraged. Production costs were sky high. Sales were plummeting. Is a recipe for disaster.
So this near-death experience, as you can imagine, totally reshaped their approach to risk.
Absolutely. Never again. That became their mantra. They weren't going to be caught off guard like that ever again.
So how did that translate into their actual strategy?
Well, they developed this two-pronged approach to really safeguard their future.
Two prongs. Okay, lay them on me.
All right, first, they were committed to minimal debt
Minimal debt.
and high liquidity. They didn't want to be at the mercy of banks or volatile credit markets.
So basically building a financial fortress, huh? Hoarding their cash.
Exactly. Like a dragon guarding its treasure. They wanted to fund their own growth, weather any storm with their own resources, no more relying on outside forces.
Smart move. And what was the second prong?
The second prong was all about foreign exchange hedging, primarily using put options.
Ah, put options. Now, for those who might not be finance wizards,
Right.
can you break that down a bit?
Sure. Think of put options as a kind of insurance against a drop in the dollar's value. Porsche would buy these options, and that gave them the right, but not the obligation, to sell dollars at a preset exchange rate.
Okay.
So essentially, they were setting a floor for how much their U.S. sales would be worth back in euros.
Protecting themselves from losses if the dollar weakened.
Right, exactly.
yeah.
Locking in a minimum exchange rate. And remember, they got burned by currency fluctuations before, so they were being extra cautious.
Yeah, makes sense. But what's really striking is the scale of their hedging program.
Oh, yeah.
In 2007, they had something like 12 billion euros
12 billion.
in put option.
It was huge. Almost 3 times their annual sales outside of Europe. They were committed to eliminating any speculation on currencies.
Wow. So their philosophy was don't try to beat the market, just protect yourself from it.
Exactly. Consistent hedging, that was their mantra. They weren't interested in risky bets. They just wanted predictable and stable earnings.
But here's where things get really interesting. Porsche wasn't content with just hedging currencies. They set their sights on acquiring a stake in Volkswagen,
Now, that was a bold move.
a company significantly larger than themselves.
Huge. A mass-market car manufacturer that was struggling with profitability at the time.
So in 2005, tiny Porsche wants a piece of giant, somewhat troubled Volkswagen.
Yeah.
Why? It seems counterintuitive.
Right. It raised a lot of eyebrows.
On the surface, yeah.
Okay.
Why would a niche sports car maker go after a, well, kind of behemoth like that?
Well, there were a few things at play.
Okay.
First off, Porsche and Volkswagen, they were already deeply intertwined. Think about it.
Yeah.
VW was supplying around 30% of the components for Porsche's cars.
Oh, I see. So they were reliant on them.
Yeah, plus they were collaborating on joint ventures, shared platforms for SUVs, all sorts of stuff.
So if someone came in and, say, broke up Volkswagen,
Yeah.
that would be a major disruption.
Huge disruption to Porsche's supply chain, their operations. They feared a hostile takeover, maybe by a hedge fund looking to make a quick buck by dismantling VW.
So this was Porsche trying to protect its own interests.
Yeah, absolutely. It was a strategic move to maintain stability and control over their own destiny.
But it also seems kind of ironic, right?
Oh, yeah.
This company that almost went bust, they were now making a move that some would call incredibly risky.
Yeah, some people saw it as a throwback, to that old school German corporate culture where companies prioritize cooperation over cutthroat competition. They protect each other from market pressures.
Interesting. Others saw it as a conflict of interest, especially with Ferdinand Piëch,
Right.
holding key positions in both Porsche and VW.
Definitely raised some red flags there.
It's amazing how one move can be interpreted in such different ways.
It's all about perspective, isn't it?
Yeah, it really is. So Porsche was walking this tightrope, right?
Yeah.
between their risk-averse philosophy and this bold strategic maneuver.
They were trying to balance those two impulses,
Yeah.
trying to find a way to protect themselves while also seizing an opportunity.
And they were hedging their bets, even with this aggressive move. They used call options on VW shares to protect themselves against price increases. So remind me, call options, those are like the opposite of puts, right?
Exactly. Instead of betting on the price going down, like with a put, they were betting on it going up.
Right, right.
If the price of VW shares rose above a certain point, they could buy them at the lower predetermined price.
Clever. So they were saying, we want a piece of VW, but we're not going to overpay.
Exactly. They were mitigating the risk of getting priced out as they built up their stake.
And what's fascinating is that the details of those option deals, they were kept pretty secret.
Yeah, shrouded in secrecy. We know they played a big role, but the exact scale and mechanics, it's all a bit of a mystery.
It adds to the intrigue, for sure.
It's a reminder that a lot of this high-stakes maneuvering happens behind closed doors.
Yeah.
It's like a game of chess, with moves and counter-moves that we only get glimpses of.
So they're quietly accumulating VW shares, and then they hit a critical threshold.
30%.
30%, right? Which triggers a legal requirement.
German law. If you own more than 30% of a company, you have to make a mandatory offer to buy all the remaining shares.
Ah, a rule to protect minority shareholders.
And prevent stealth takeovers. So now Porsche's in a bind.
They want to control VW, but they're not necessarily ready to buy the whole thing.
Exactly. So what do? They get creative.
Lay it on me.
They offer the absolute minimum price required by law, which was way below the market price.
Wow, that's bold. Almost like daring the other shareholders to accept.
Right. They fulfilled their legal obligation while also signaling that they weren't really serious about buying the whole company just yet.
So it was a clever tactic, but it also shows how they were using the rules to their advantage.
They were playing the game, and they were playing it well. But while all this was happening, something else was going on.
What's that?
Their financial engineering. It was starting to pay off. Big time.
So we've talked about the risks and the strategies, but now let's talk about the rewards. Give us the numbers. What kind of impact did this have on Porsche's bottom line?
Let's look at their 2006-2007 financials. Their pre-tax profits. 5.9 billion euros.
5.9 billion.
Yeah, on sales of 7.4 billion.
That's huge. But where did those profits come from?
Hold on to your hat, because this is where it gets really wild. 3.6 billion euros from their VW stock options.
More than half their profits from playing the market?
It was a mind-blowing figure. Another 1.2 billion.
Yeah.
From their share of VW profits.
So they were making more money from finance than from actually building cars.
It's crazy, right? Their core business, which was doing well, mind you, only contributed 1.1 billion.
That's an incredible turnaround.
Talk about a side hustle.
So some people are hailing their CFO as a genius.
Oh, absolutely. They were pulling off these incredible returns. But others are worried.
Worried about what?
The risk. It seemed unsustainable to some. What if the market shifted? Those gains could vanish overnight.
So was this really just a massive gamble that happened to pay off?
That's the million-dollar question. Were they masters of risk or just incredibly lucky?
A question we'll keep exploring, but one thing's for sure. This was not your typical car company story.
Not at all. They were operating on a whole other level. And then, of course, the world changed.
2008.
The financial crisis. Nobody was immune to that. And Porsche, with all its intricate financial positions, was about to face its biggest test yet.
So last time we left off with Porsche, raking in huge profits.
Yeah.
Much of it from their savvy moves in the financial markets.
Right.
But this was 2007, right before the whole world changed.
Yeah, 2008.
The 2008 financial crisis.
Nobody saw it coming.
That had to have impacted things for Porsche.
Oh, absolutely. The 2008 crisis, it was a true test of, even the most carefully crafted risk management strategies.
And Porsche, with their complex financial positions, I mean...
They were right in the thick of it.
So let's break it down a bit.
Okay.
Their big strategy was hedging against a weak dollar, using put options.
Yeah.
Did that provide any cushion when the crisis hit?
Well, initially, yes. The dollar did plummet against the euro, just as they had anticipated.
Right.
And because they had locked in that minimum exchange rate, their hedges, they did pay off.
At least at first, right.
Yeah, at least at first. But things were about to get a lot more complicated.
What do you mean?
The crisis, I mean, it was so widespread, so unpredictable, it created a whole new set of challenges for Porsche. The global financial system was basically melting down, and even the euro, which they had hedged against, became incredibly volatile.
So their assumptions, their whole 3-year outlook that their hedging was based
Is
on,
out the window.
gone.
Nobody knew what was going to happen next.
Yeah, and on top of that, they had their big Volkswagen takeover plan in motion,
Oh,
which was already controversial, to say the least.
yeah. A lot of people were questioning it.
Did that start to unravel under the strain of the crisis?
Well, yeah, they were so close to getting a controlling stake in VW.
They were, weren't they?
But the financial crisis basically threw a wrench in the works.
Yeah.
They had been using debt, right,
Right.
to finance their VW share purchases.
Mm-hmm.
When the credit markets froze up, that debt suddenly became a huge problem.
So their never again approach to debt.
The one they swore by after the 90s?
It came back to bite them.
In a way, yeah. I mean, their debt levels weren't crazy by industry standards, but the financial landscape had shifted so dramatically almost overnight, and it left them exposed in a way they never could have predicted.
So their risk management, their whole philosophy of stability, minimizing debt.
It all backfired.
Porsche, the company that thought they had outsmarted the market,
Yeah.
they ended up trapped by it.
It was a classic case of, the best plans of mice and men.
So what happened? Did they just, crash and burn?
They're definitely in a precarious position facing a potential liquidity crisis. They needed a solution, and they needed it fast.
So what did they do?
Well, remember how they swore off relying on banks?
Yeah, never again.
Well, in a twist of irony, they had to turn to those very institutions for help.
No way. Talk about a humbling experience.
It's a tough pill to swallow, for sure. But they were desperate. They needed a lifeline, and the banks, despite all the risk, were ultimately willing to provide it.
So Porsche, the champions of financial independence?
Yeah.
They had to go crawling back to the banks they had once shunned?
It was a complete reversal of fortune.
But was it a straightforward bailout?
No, not at all. It was a complex, messy process. Lots of negotiations, government involvement.
Yeah.
Nobody really knew what was going to happen.
Yeah, and you have to remember, Volkswagen was
Huge.
a giant of German industry.
Right, with lots of stakeholders, political sensitivities. This wasn't just about saving Porsche.
It was about the fate of Volkswagen as well.
Absolutely. It was a high-stakes game with a lot riding on the outcome.
So what happened? Did they manage to strike a deal?
They did.
Yeah.
But it wasn't what anyone expected.
Mm-hmm.
Instead of Porsche taking over Volkswagen,
Yeah.
a reverse takeover took place.
What? A reverse takeover?
Yeah, Volkswagen basically absorbed Porsche. They became the dominant entity in this newly formed automotive group.
So the hunter became the hunted.
Exactly. The company that had meticulously planned to take over VW ended up being subsumed by it.
That's crazy.
It really shows you how unpredictable the markets can be, especially during a crisis like 2008.
So much for careful planning.
Sometimes you just have to roll with the punches.
This whole saga, it really makes you think about risk, ambition, and the limits of control.
Absolutely. It's a cautionary tale, but also a story of resilience and adaptation.
So what are the big lessons here? What can we learn from Porsche's experience?
Well, I think it shows that even the best laid plans can go awry.
Especially when a black swan event like the 2008 crisis hits.
Right, you can't predict everything, and sometimes you just have to be prepared to adjust course.
But Porsche also showed that they could adapt.
Yeah, they were forced to, but they did it.
They went from almost going bankrupt to making bold moves in the market.
And then they had to adjust again when the world changed.
So what's next for Porsche? And for the entire automotive industry as they face all these new challenges?
Well, that's a question we'll tackle in the next part of our deep dive.
Okay, so we're going to shift gears from the past to the future.
Exactly. We'll explore what Porsche learned from these wild times.
And how they might apply those lessons as they navigate, the rapidly changing landscape of mobility and technology.
A whole new world out there.
We've seen how Porsche, a company known for precision engineering and a pretty conservative approach to risk, they really found themselves navigating some pretty turbulent waters.
Oh, yeah. High finance, a global economic crisis. It was quite a ride.
From near bankruptcy in the 90s to that ambitious and ultimately thwarted attempt to take over Volkswagen.
Yeah, quite a story.
But as we kind of shift gears from the past to the future,
Right.
the question becomes, what did they learn from all of this?
Yeah. What are the takeaways? How can they apply those lessons to the challenges they're facing now?
And there are a lot of challenges, right? I mean, the automotive industry is going through this massive transformation.
Absolutely. It's a whole new ballgame out there.
Driven by, technology, changing consumer preferences, and of course, climate change.
Yeah. All these forces are converging, reshaping the industry.
And companies like Porsche, with their history of innovation,
Yeah, their engineering prowess.
they're in a unique position, I think, to lead the way.
They have the potential, that's for sure.
But it's not just about, incremental improvements
Right.
to existing car models anymore,
Right.
right?
It's much bigger than that.
We're talking about a fundamental shift in how we think about mobility itself.
Exactly. Electric vehicles, autonomous driving, connected cars, shared mobility, all of it's converging to disrupt the traditional model.
And for Porsche, known for their high-performance sports cars, their
It's a
exclusivity,
whole new world.
this new landscape, it presents some real challenges, but also some exciting opportunities,
Oh,
right?
absolutely. I mean, take electric vehicles, for example. Porsche has made some impressive strides with models like the Taycan.
Yeah, that's a beautiful car.
It's gotten rave reviews. But the transition to an all-electric future, it's a
Yeah.
huge undertaking.
Huge, yeah. Massive investments in R&D, battery tech, charging infrastructure. I mean,
And even rethinking how they manufacture cars.
yeah,
It's a complete overhaul.
it's not just about swapping out the engine, it's a systemic shift.
And then you have the competition.
Oh, yeah.
Tesla, for example.
All right, they've got a head start.
With their Silicon Valley approach, they've really raised the bar.
Can traditional car makers like Porsche keep up? That's the big question.
Yeah, it's a good question. And this is where their experience with Volkswagen might actually come in handy. They've shown they can forge these strategic partnerships
Even with seemingly unlikely partners,
to achieve a common goal.
they're not afraid to collaborate when it makes sense.
So could we see Porsche partnering with tech companies, battery manufacturers,
Maybe even other car makers?
to really accelerate their progress in the EV space? It's definitely a possibility. They could leverage their strengths, their design, their engineering, their brand prestige, and then tap into the expertise of others who are further along in areas like software development or battery production.
Combining the best of both worlds.
Exactly.
Right.
The heritage and craftsmanship of a classic car maker with the agility and innovation of these tech-driven disruptors.
Now that's a potent combination.
It could be a real game changer.
And this approach, I mean, it could also apply to autonomous driving, right?
Oh, absolutely. Self-driving cars, that's another huge disruption on the horizon.
Yeah, and it's complex, it's expensive.
AI, sensor tech, data analytics. It's a whole new set of skills.
Not something a company can easily do on its own, I imagine.
No, it's too much for one company to handle.
So again, strategic partnerships, maybe even acquisitions,
They could be key for Porsche.
collaborating with companies that specialize in specific aspects of autonomous driving.
Right. Focusing on their core competencies and letting others handle the rest.
It's like that, what do they call it?
Co-opetition.
Yeah, co-opetition.
Where rivals in some areas decide to team up in others.
Makes sense, especially in an industry that's changing so fast.
You gotta be flexible, gotta be willing to adapt.
But there's another trend we haven't really talked about yet.
What's that?
Shared mobility.
Yes.
Ride sharing, subscription models,
The whole idea of car ownership is being challenged.
especially in cities where convenience and cost often trump actually owning a car.
Yeah, people are rethinking their priorities.
So how does a company like Porsche adapt to that?
It's a tough question. They're known for selling these high-end cars to individuals. What happens when fewer people want to own cars at all?
They might need to rethink their whole business model, right?
It's possible. Could they offer their own subscription service?
Interesting.
Give customers access to a fleet of different Porsches for a monthly fee.
Or partner with existing mobility platforms.
Integrate their cars into shared networks, yeah.
Maybe leverage their design expertise to create new mobility solutions.
Tailored for a world of shared transportation.
High-end, on-demand services, something like that.
It's an intriguing possibility. They could become providers of mobility experiences.
Not just car sellers, but experience creators.
It's a subtle but important distinction.
And this is where their experience with risk management and, their boldness comes in.
They'll need to assess the risks, but also be willing to experiment, to try new things.
To adapt as the market evolves.
That's the key to survival in this new world.
It's a fascinating challenge, and it'll be interesting to see how they handle it.
They've got a rich history of innovation, and they've learned some valuable lessons along the way.
Yeah, they've seen both triumph and adversity.
That's for sure.
Well, deep divers, we've covered a lot of ground in this exploration of Porsche's journey.
From near collapse to financial maneuvering to the challenges and opportunities they face now.
What are some of the key takeaways you hope our listeners will take away from this?
Well, I think Porsche's story shows us that even companies known for being conservative, they can benefit from taking calculated risks,
Yeah.
from challenging conventional wisdom,
Finding that balance between prudence and audacity, right?
understanding the risks, but also being willing to seize those opportunities.
The ones that might seem counterintuitive at first.
It's about having a vision and then finding a way to make it happen.
And then, of course, being able to adapt when things change.
Because they always do.
The 2008 crisis really highlighted that, didn't it?
It showed us that we can't predict everything.
But we can try to be prepared for the unexpected.
To cultivate that flexibility, that resilience.
And finally, I think Porsche's story shows the power of partnerships. They realized they couldn't do it all alone,
Nobody can.
especially in a fast-changing industry,
So it's about knowing your strengths, finding the right partners,
and building those alliances that can really drive innovation.
and create new opportunities.
Whether you're leading a company or just managing your own career, I think there are some valuable lessons here.
I agree. Porsche's story is a reminder that we all need to be adaptable, strategic, and maybe a little bit bold,
Yeah, sometimes you got to take a chance.
but always with a clear understanding of the risks involved.
Thank you for joining us on this deep dive into the fascinating world of Porsche.
It's been a pleasure.
We hope you've enjoyed the ride.